Finding great candidates to hire can be like, well, trying to find a needle in a haystack. Sure, you can post your job to some job board, but then all you can do is hope the right person comes along. Which is why you should try ZipRecruiter for free at ziprecruiter.com/zip. ZipRecruiter doesn't depend on candidates finding you, it finds them for you. Its powerful technology identifies people with the right experience and actively invites them to apply to your job. You get qualified candidates fast. So while other companies might deliver a lot of hay, ZipRecruiter finds you what you're looking for. The needle in the haystack.
See why 4 out of 5 employers who post a job on ZipRecruiter get a quality candidate within the first day. ZipRecruiter, the smartest way to hire. And right now, you can try ZipRecruiter for free. That's right, free at ziprecruiter.com/zip. That's ziprecruiter.com/zip. ziprecruiter.com/zip.
You hear a lot about how Americans are not saving enough for retirement. Well, today on Money Life, you get a chance to see how you measure up.
The average participation rate for retirement plans now is 85%, meaning only 15% of workers that have access are not contributing to their plan. We're also seeing average all-time highs in savings rates as well. So the average total savings rate, how much people are saving between both their own paycheck and what their employer is contributing, is up to 12%.
That's Jeff Clark, head of defined contribution research at Vanguard. And they recently released their latest How America Saves report. The news is actually pretty good. The average contribution, 12%? Hard to believe, but if you're not there, maybe that's what you should be aiming for. But before Jeff discusses that, we've got Todd Rosenbluth, head of research at VettaFi, here with his ETF of the week. Later, Jed Ellerbrook, portfolio manager at Argent Capital. We'll talk stocks with me in the market call, and I will give you my take on what's going on with Fed independence and how it could shake out.
Let's get moving.
Yeah, let's get moving indeed. Welcome to Money Life for August the 28th. I'm your host, Chuck Jaffe. Thank you so much for being here. Yeah, today may be a day where you've got to see how do you stack up, because we've got the How America Saves research. And yeah, if it's 12% and you're doing less than that, and again, that's not all on you, that's you and your employer. I will point out that Vanguard's looking at its customers. It's not entirely going, okay, here's what everyone's doing. This is the average of people who are saving. So you could make yourself feel better if you want to go, wait, hold it. This is not everyone. There are those people that don't have savings, that they're not doing anything, et cetera, or that they're saving in some horrible plan. So they're not doing what Vanguard's doing because Vanguard's researching its own customers. But you're talking about the largest provider of retirement plans and what their customers do. And it's real world data. It's not, you can't question this. You can't go, oh, what are the survey methodology or whatever. This is what their customers do. So that is something that gives it, in my book, extra credibility. I love that the trends are good. And they're not the only ones. I mean, we've seen other things that say more Gen Xers, et cetera, are saving and doing the right thing. All good. There's nothing bad in that. The bigger questions are, is it enough? And what's going to happen that makes it that stuff will be challenged in terms of building lifetime nest eggs. But it's a great discussion to have. Todd Rosenbluth last week with his ETF of the week went all the way to Bitcoin options and a 27% yield. His pick this week, the entire opposite end of the spectrum. It's kind of fun with that. Jed Ellerbrook is here, portfolio manager for Argent Capital and the Argent Large Cap ETF, brings an interesting methodology. He's never been on the show before, though one of his colleagues was on 4 or 5 months ago. But I always like to get your take when we have new guests on, because we're always looking to broaden our perspectives. Not that we don't love the guests we've got, but bringing more and better people on, different people, like to get what your take is. And I'll still say that while some of you have stepped up and filled the void of Rich from Orchard Beach, Maryland, who, if you listen to the show, was a huge fan, passed away. Rich used to tell me about pretty much every guest, like especially the new ones. Like this guy, you should have him back, et cetera. Now, a bunch of you, for example, when we had Jenny Harrington on recently, we're like, sure, her energy was great. Let's do this again. And we will. We have rules about how often somebody can be back, but I can promise you we'll get her back. And those comments do mean something to me. And a couple of you every now and again will notice, you didn't say, hey, can't wait to have you back. Sometimes that's because I didn't like the guest. Sometimes that's because we're really busy on the way out of the interview. That's what we've got coming for you today. I would take more time, but I'm going to take my time when I'm talking about the Fed. And I think that's really important. That story is breaking as we discuss, so there may be more action on it, but you'll still get my general take on what it all means, etc. And if you've got a take, write me, chuck@moneylifeshow.com. But right now, let's go. I've told you what's coming. The ETF of the week kicks us off next.
Everything an advisor needs in one newsletter. Go to advisorperspectives.com and see why 100,000 advisors are subscribed to our newsletter.
One fund on point for today, the expert to talk about it. Welcome to the ETF of the week. Yes, this is the ETF of the week, where we get the latest take from Todd Rosenbluth, the head of research at VettaFi. And if you go to VettaFi.com, you'll find all the tools you need to be a savvier, smarter ETF investor and to get more details on the new, newsworthy, trending, and timely ETFs that we talk about here. Todd Rosenbluth, great to chat with you again.
It's great to be back.
Your ETF of the week is
The PIMCO Enhanced Short Maturity Active ETF, ticker MINT, Mint.
Mint, M-I-N-T, the PIMCO Enhanced Short Maturity Active ETF. Now, Todd, last week we were talking about a Bitcoin tied fund that with a massive yield, et cetera. This could not be really more on the other end of the spectrum. I mean, it is actively managed, but it's short maturity bonds. This is a very conservative pick. Why this pick now?
Well, you said new, newsworthy. No, actually, no, this is a 15-year-old ETF that is probably as boring as one could get in a good way. So this ETF from PIMCO Mint has been around. It's the oldest of those actively managed fixed income ETFs. We got indications from the Federal Reserve that rate cutting is likely to occur in September. We think that could to help spur people to move money off the sidelines. There's roughly $7 trillion of money sitting in money market funds when it could be earning much more from a actively managed ETF like this one. We wanted to spotlight this. I believe this has been ETF of the week in the past, but we think it's a good time to talk about it again.
The question that I have with this fund, it's a great parking place and it has proven itself. And it is newsworthy because it's a decision that you're making relative to the change in interest rates. But some people would have said, if you're going to have rate cuts, you want to lock in longer maturities. In this case, you're saying, I'm going to keep getting whatever payout I can and I'll shorten maturities. So why the short maturity play when rates are being cut?
Well, it matters where you're coming from. So if you're sitting in cash, in actual cash in a money market fund, you're not going to be earning as much as the Fed continues to cut interest rates. They've done it in the past, in the recent past, but they were on pause for a period of time. So for people who are looking to move off the sidelines and put a little bit of money to work and earn a 4.5% yield, this is a good way of going. There are other ETFs, maybe we'll talk about them in subsequent weeks, that take on much more interest rate sensitivity and a longer term focus. This, as you noted, is an ultra short bond ETF that is going to protect you. But if you're not in the market and you're just sitting in cash, this is a better alternative, and you're going to benefit from the experts from PIMCO. Jerome Schneider and team have been running this fund for years. They've got a proven track record. PIMCO has been a leader within the active fixed income suite. They're a firm I think many people turn to get exposure to the ETF world through active management.
I think, Todd, you may be selling this one just a little short when you said the yield is 4.5, because the last time I checked, the yield here was closer to 4.9, which puts it just under 5. And for some perspective on why that's important, if somebody goes to check out the best high yield savings accounts, best they're going to find is about 4.3. If they're going to money market funds, according to Crane data, the best money market funds are yielding also about 4.3, maybe up to 4.4. So this is above that. When we see rate cuts, this is likely to stay above that. I mean, every penny counts, doesn't it?
Every penny does count. And, you're going to get the benefits of active management to navigate through this environment. So this fund is investing across the fixed income spectrum, investment grade corporates, again, short term, but securitized debt. It'll have some exposure to government bonds, but not entirely. So you're taking on a bit of credit risk, but not a lot, and certainly something you can benefit from that experts at PIMCO.
There are plenty of people who have some allocation to bond funds. If they've got a short allocation, you're not really making an allocation call, so they don't need this fund if they've got one in there already, do they?
I guess it matters how conservative or aggressive they want to be. So my angle initially was if you're sitting in cash or a money market fund, as you know, the data shows that this ETF Mint offers you a higher yield and a higher, in my opinion, total return potential, modest at best, but still total return potential. If you've taken on more risk than you're comfortable because you see the volatility ahead in the marketplace, the stock market has done very well and you're looking to pull some money off the table, Mint can be a good way for you to take some profits and earn some income along the way. So this can serve multiple purposes, either from a parking standpoint, as you mentioned, or moving out of cash and taking on a little bit more risk for a little bit higher income.
Every now and again, you and I talk about what others think of a certain fund that we've made ETF of the week. And one of the things that's interesting to me about this fund is that from the standpoint of Morningstar and Lipper, it's kind of middle of the pack. It's a 3-star fund for Morningstar. It gets 3s in every Lipper category except for preservation of capital, where it does get a Lipper leaders mark. So I guess I'm curious, this is the old and stodgy pick at a time when we do ETF for the week. Is this the most exciting of the ultra shorts, or is this the one that you think everybody's going to be comfortable with?
So let me cover what do others think in a moment. But money has been going into this ETF, about $500 million in the last 3 months. So for investors that are looking for an active ultra short bond ETF, PIMCO's Mint has been a beneficiary. There's a lot of tools, a lot of products that are out there. Nobody with a 15-year track record as an ETF the way that PIMCO has. I would note that the category is probably pretty narrow in terms of the highs and the lows in terms of performance record. You're not looking for an ETF like this to be an outperformer in an up market. And we've been in an up market for much of the last 3 years. So I think a 3-star rating is reasonable. The difference between a 3 and a 4 and a 3 and a 2 is probably basis points differences in terms of performance. And yeah, that capital preservation that Lipper is noting, that I think is important for people who are buying an ultra short bond ETF. You kind of want that. You want stability in this, but you want some potential for upside because of the active management capabilities. I think with PIMCO's Mint, you get that in spades.
I think it's a really important lesson that, don't be so caught up in the ratings that you go, wait, hold it, I could do better, when you can't really do much better when it comes to the actual payouts you're going to be getting. You're talking about de minimis amounts, et cetera. I think that's a really good lesson to teach. And it's one more lesson we take out of Mint, the PIMCO Enhanced Short Maturity Active ETF. The ETF of the week from Todd Rosenbluth at VettaFi. Todd, great stuff. We'll see you again next week.
Yeah, and go blue. It's the kickoff for college football season for Michigan.
Absolutely. Well, for everyone, good luck out there, but for Michigan especially. Todd Rosenbluth is head of research at VettaFi. Go to VettaFi.com to get more information on the firm. Check out its research on your favorite ETFs, or maybe the ones you're looking to become your next favorite ETFs. And of course, Todd starts us off every Thursday here on Money Life, and we are just getting started. We'll be talking with Jed Ellerbrook from Argent Capital in the market call, but we got a lot of stuff to do before we get there, including up next when we're talking about how America saves with Jeff Clark from Vanguard. Stick around. This is Money Life.
Looking to earn CE credits and hear from top portfolio managers? Go to etftrends.com/webcasts and learn more.
Now let's take a look at what the survey said. Yes, welcome to the Survey Said on Money Life. This is where we dig into surveys, studies, polls, any kind of research or data that's going to help us understand what people are doing for, with, and about their money. And today we are going to be looking at how America saves. No, literally, we're going to be looking at that because that is an annual report that Vanguard does. So we are looking at how America saves 2025, their latest research on what people are doing in their retirement plans and more. Here to discuss it is Jeff Clark. He's head of defined contribution research at Vanguard, which is online at vanguard.com. But if you want to get directly to how America saves, if you maybe want to see how you stack up to the rest of America, well, we've got a direct link that's in our show notes or on our guest page at moneylifeshow.com where you find Jeff Clark. Jeff Clark, it's great to have you back on Money Life.
Thanks for having me, Chuck. Great to be back.
You know, I really am curious about your statistics at Vanguard because the national statistics, separate from any headlines about how good is the data or how bad is the data or anything else, it seems like we've got studies that are kind of going in multiple ways, kind of against each other. Some are saying savers are doing better. Others are saying savers are doing worse because they're more stressed by inflation, et cetera. So the basics, because of course, this was really done before we started to see a lot of the inflation and tariff stuff kick in, but the basics on the current state of where savers are with their retirement plans is what? Are we making progress or are we losing ground?
We are definitely making progress when it comes to how workers are saving in their 401k plans. So as you mentioned, with How America Saves, this is our 24th edition. This is an annual report that Vanguard puts out, and it really follows the behaviors of about 5 million participants that are contributing through their employer-based 401k or 403b plan. And I would say overall, the most promising aspect is that employers are continuing to make it easier for workers to save for retirement. And what do I mean by that? Auto enrollment is at an all time high. Employer contributions are at an all time high. More retirement plans are allowing workers to start contributing immediately once they are hired. And what this has led to is record highs in participation rates. So the average participation rate for retirement plans now is 85%, meaning only 15% of workers that have access are not contributing to their plan. We're also seeing average all-time highs in savings rates as well. So the average total savings rate, how much people are saving between both their own paycheck and what their employer is contributing, is up to 12%. And on the investment side, just as auto enrollment is helping more workers save for retirement, target date funds, advice are helping participants with their investment portfolios. So 67% of all participants now are using simply just a target date fund, or they're using an in-plan managed account advice service. And so, I think really what this also is pointing to is a lot of increased resiliency for retirement savers as well. Even as you think about all of the volatility that we've been kind of going through with both, the economy, as with interest rates, with inflation, with the stock market earlier this spring, we see a lot of increased resiliency in just how participants are continuing to increase their savings and also staying the course with a lot of their investment selections as well.
You talked in there about the participation rate, and then you talked about the savings rate. And in the savings rate, you were clear that the savings rate is as high as it is because you were considering the contributions of both the individual and the employer. In the participation rate, how many folks are actively participating? Because you said it's 85%, but is there a group of folks that they're only actively participating because their employer is saving for them and they're not saving for themselves?
So there are some some workers that may not be participating, but they're receiving some type of a non-match employer contribution. The majority of retirement plans do offer employer match contributions. 85% of all workers that have access are contributing actively to their retirement plan. I would say about 85% of retirement plans also offer an employer matching contribution to help promote, strong retirement savings.
Well, that would help explain it. That means that people are at least doing the minimum they've got to do in terms of capturing the match. You talked about how plans are doing more with it and having more automatic enrollment and first day enrollment. Are we also seeing an end to a lot of the things that used to be kind of a pain in the butt for young workers? I know my oldest daughter recently changed jobs, and her 401k had a vesting thing, and she didn't change it. She changed jobs because they said, hey, we're changing the way we're going. So we're getting rid of some teachers on this side and we're adding some teachers on that side. We don't have a job for you. And she wound up losing in her 401k because they still had vesting requirements. And I was like, really? We still have vesting requirements? So how much are we phasing out some of those old things that used to be there?
So the trending that we have on vesting schedules is that vesting has not changed materially over the last few years. We are seeing increased eligibility. We are seeing some plans start to think about auto portability. So when someone does leave their plan, that those assets, if it's a smaller balance, can kind of follow them with them to their new employer. We are really, at the end of the day, auto enrollment, though, is really helping as workers are changing jobs more frequently. It's getting workers in saving immediately, and then employers are also increasing those initial defaults. And so, many years ago when auto enrollment first came on the scene, the vast majority of those plans defaulted workers in at 3%. We're seeing more and more employers start that initial enrollment default at least that maximum employer match rate, so that when workers do sign up or they are auto enrolled, they are able to start saving and receive that full employer match contribution.
There are a lot of studies that talk about how investors are using their retirement plans, how they're getting into their 401ks and going, okay, I've never had anything for retirement before, and I'm investing too conservatively. I'm taking, stable income choices, guaranteed income choices in the GIC rather than taking an index fund. Have we seen investor behaviors because of things like life cycle funds, et cetera, and target date funds make it that investors are not just investing more, but they're investing better?
Absolutely. The vast majority of all plans now are defaulting. Their initial investment default are target date funds. And so what we have found now is that as a result, 67% of all participants are in a professionally managed allocation. In fact, 85% of participants have some of their assets at least in target date funds. And it's drastically improved age appropriate allocations. You mentioned, with many years ago, before target date funds, the default fund for retirement plans was a money market or a stable value fund. And so you would find a lot of participants that were unsure of which investments to go in, and they would just stay in that default fund that was fairly conservative. And so we've seen a dramatic increase in the percentage of participants that just have a more age appropriate allocation, especially among younger workers. And you think about, just the power of compounding, that's quite significant.
What percentage of people are investing, making all their own picks from whatever choices are available versus the picks, the ones that are just saying, I'll take the default choice?
Yeah, so if you think about the 67% of participants that are in professionally managed allocation, the other one third are essentially those participants who have developed their own allocation. So they are either using a combination of different funds, or they're just maybe just using one other fund that might not be a target date fund. And what we have found is that younger participants are definitely more likely to be using those professionally managed allocations. It's typically older participants. About half of participants over the age of 55 are sort of, doing it themselves with those investment allocations. And one of the reasons might have been is that, for a lot of those older workers, they came into, their 401k plan before target date funds were the default or even on the investment menu. And so they've really been doing it themselves their entire career. And so we have seen, especially for younger workers, the powers of auto enrollment, but then also a lot of these defaults with target date funds are really helping just to provide a much better retirement outcomes. Because at the end of the day, if you think about retirement savings, it comes down to saving enough, which Vanguard would typically recommend saving about 12 to 15%. And investing appropriately. And a target date fund is a great place to start in just getting a well-diversified and balanced portfolio.
Well, let's move away from the well-diversified and balanced portfolio to get to the news, because off the news recently, we had the announcements that there were going to be a lot more leniency when it comes to things like crypto and other things made available in retirement plans. And plenty of people talk about whether that's a good thing or a bad thing. That's not really where I want to go with you, Jeff. I'm just curious. How many folks are really interested? Crypto soaks up a lot of headlines for an asset that is not necessarily held by a lot of people. So it made a bunch of headlines, but how much real interest is there in having crypto in 401k and other retirement plans?
Well, yeah, we all saw the executive statement that Trump rolled out. And I think what the next step is from here is really just for the Department of Labor to start to offer some guidance. At the end of the day, when you think about retirement savings, it's all about having, a well-diversified, cost-effective portfolio. And so I think, there's a long ways to go, I think, before, we really start to think about ways of incorporating any type of private assets or crypto.
Given that permission and given the fact that it's hard for the people who do what Vanguard, but what every provider of life cycle funds and target date funds does, do you believe that we will start to see target date funds now that include a crypto allocation because, hey, we can, and now I can somehow distinguish myself from the other provider?
Yeah, I think at the end of the day, a lot of it comes down to, plan sponsors thinking of it from a fiduciary perspective, and making sure that, that the costs are reasonable and that it's also something that, for the vast majority of their participants, that they're going to be able to have, a clear understanding, of what those investments are. And so, like I said, I think there's still a ways to go until we start to see developments in any type of target date funds.
Jeff, really interesting. I got more questions. I don't have more time, but I do know that you guys will continue to do the study. So if nothing else, I'll expect to talk to you again next year when How America Saves 2026 is out.
Sounds good. Thank you very much, Chuck.
That's Jeff Clark. He's the head of defined contribution research at Vanguard. You can go to Vanguard.com for more information, or you can go to the direct link that's in our show notes. That'll get you directly to How America Saves 2025. And how America lives the money life? Well, they do it by not quitting, because we've got much more to go on today's show. So like your retirement plan, keep everything in place, as you know that we're going to come back and there's going to be more good stuff to talk about in just a moment. Welcome back to Money Life, where a number of you have asked questions about the Fed and wanting my take on what is going on with the Fed. Not so much on interest rates, but on Fed control and what it means and whether or not it's as alarming to me as it is to some other folks. And, I do have a degree in economics, although it's a long time ago, and I don't claim to be the expert that my guests are. But I will say that I am very worried about what I see. I don't want to necessarily be in that crowd that says, oh, you're just spouting off, et cetera. It's not, this is not to me about politics, and it shouldn't be about politics. I don't want the Fed controlled by any president. It's just not a good thing. And you saw something happen on Wednesday. Treasury yields got closer to 5% because there was a warning about the threat of future inflation. That's when people talk about a steepening of the yield curve. That's what you saw. Long dated rates rise at a faster pace relative to shorter dated rates. The yield curve can steepen for good or bad reasons. So we could have had good reasons, but we didn't yesterday because there was the chance that inflation might accelerate if the Fed loses some of its independence. And that's the part that scares me, right? If the Fed loses its independence and it acts in line with what the politicians want, you could have bad inflation. Inflation could get worse. And the example everyone keeps using right now is Turkey. But let's not use that example. If you are of a certain age, my age or older, if you are in your 60s, your earliest memories, economically speaking, are the fact that your parents were struggling in the 1970s to deal with inflation, right? And they were struggling in part because Richard Nixon made an effort. Arthur Burns was the head of the Fed. I didn't know his name then. I've known it since because I've studied the history, to have more control. The control that he wanted created inflation. You had efforts that were done where the Fed basically, to kowtow to the politicians, lost sight of its mandate. And when that happened, we had inflation that was ridiculous. I mean, you had money market funds in 1975 paying 12%. You had mortgages that were double digit. Everyone makes the comparison to emerging markets and they say, oh, if this happens, we're more like an emerging market. Okay. We're more like what this country was doing in the 70s at that point. So let's look at a couple of things and why I say I'm concerned and where things might be standing right now. You know that the president the other day made an effort to fire Lisa Cook, a Fed governor. He accused her of making false statements on 2 mortgage agreements, telling her that the situation calls into question your competence and trustworthiness as a financial regulator. I will point out that one of his trials was all about statements he was making while applying for loans. On the one hand, you could say he's an expert on the subject. On the other hand, you would say it's not necessarily cause for removal of anything, if you think about it. Whether there's actual fraud, given that there's been no crime charged, et cetera, is also a big issue. She needs to be fired for cause, and cause means to have committed a crime or a massive malfeasance. And she's saying she's going to sue and she's going to carry out her duties at the Fed. Her attorney will be filing a lawsuit, or so they say. I don't like talking about lawsuits that haven't been filed, but he described Trump's actions as illegal. And the Fed says it'll abide by any court decision. So if the courts say she's out, then she's out. If the courts say she's in, she's in. But in the meantime, she may be there. Meanwhile, the Fed is also looking at having a new pick. Stephen Moran is supposed to be taking over a vacant seat held by Adriana Kugler, who surprised everybody by stepping down earlier in August. But that term only runs until January the 31st. So we're going to wind up seeing whether or not he gets confirmed. You would expect him to get confirmed. I mean, there's a Republican majority in the Senate. I'd be surprised if people voted against Trump on this. I mean, maybe they could want to send some sort of a message, but since they have not voted against the party lines on anything else, you don't expect them to do it. So I think he gets approved. You've got the threat where Trump is saying, oh, I'm not going to fire Powell, but he has attacked Powell over the renovation project at the Fed's headquarters that has had cost overruns. By the way, he's a real estate guy. He knows about cost overruns in real estate projects. But again, that's not here nor there in this case. The question is going to be, is he going to charge that or have someone charge that there's fraud in a $2.5 billion renovation project? When you hear that stuff, the market is reacting, right? If Donald Trump tells Jay Powell, you're fired, the markets would go nuts. So here's what you need to know. Firing Lisa Cook is a test of that. Whether it's true or not, whether, the allegation is true means nothing. You're kind of doing a test, seeing what happens. Then you get the idea of, you've got Powell. Will he fire him? Will he put in a shadow chair? He has put out a list of folks that he is looking at to do that. And the list is not just all of the people who he has previously talked about, but we will see how you wind up getting that. Then you've got the issue of whether Powell will resign when his term is up. In other words, he will not be Fed chair. I think we know that for sure. He will not be reappointed as chair, but his term on the board doesn't end until 2028. And he could decide he doesn't want to give President Trump the ability to put in one more governor. So he could stay. But historically, Fed chairs, when their term is up as chairman, they tend to leave. These are not necessarily normal times. If Trump gets to oust Lisa Cook and gets to name her successor, he could have majority control over the Board of Governors if you assume that anyone he picks will be a loyalist and will act in the role as a loyalist. Will not get there and go, wait, hold it. I'm going to follow the numbers, and the numbers don't suggest this should happen or what have you. We'll see. But the basics here are that President Trump wants to have a majority of the FOMC in favor of rate cuts, which would do what the president wants. But if it's about politics, if it's not data-driven, then you destroy the independence of the Federal Reserve. And that, most assuredly, is not what's best for the economy. And I don't care that President Trump told reporters on Tuesday that he'll have a majority shortly and that he followed that up with, once we have a majority, housing is going to swing and it's going to be great. Let's bring this back to the current event side of Turkey. Now, I would point out that Turkey would be like the worst case scenario, but you can't rule it out. So you've got the longtime president, former Prime Minister Erdogan, interfering with the Turkish central bank's ability to make interest rate adjustments as they needed to. As a result, Turkey's version of the lira, the exchange rate has eroded in the past decade because Turkey has had substantially higher inflation than other emerging markets countries. Its annual inflation rate, based on consumer prices, was over 33% in July, and its currency currently trades at historic lows relative to the dollar. Now, that's an economy in much worse shape than the U.S. economy, which still has a ton of things going for it, which still has the ability to avoid recession and all the rest, no matter what happens here with the Fed. But if political risk creates instability, uncertainty over policy, market volatility seen in a lot of emerging markets, nations, because of what happens geopolitically, that will make the markets dramatically more sensitive to headline risk. And we've got tons of headline risk right now. I can't say there's more than historically, but it feels that way. And one of the reasons it feels that way is that if you try to measure political risk, which there are a variety of investment firms that do that, and you then compare political risk and the direction of the 30-year Treasury yield, well, the correlation between the two has only gotten stronger in the last 7, 8, 9 years. Moreover, you look at the dollar having declined as sharply as it has since the tariffs were announced at the beginning of April, and the dollar is reflecting political risk. It's still the world's currency, but that doesn't mean it's not showing the political risk. Does it mean that, the U.S. is not going to be the most attractive market in the world? No, doesn't. There's been higher political risk, and yet the stock market's back at record highs. The higher the risk, the higher the S&P has gone. Now, that could be because of TINA. There is no alternative among the stock markets of other countries. That could be because you've got some unstoppable forces for now in AI. But if and when those forces get stopped, if and when you have real inflation, playing games with this stuff is real. Do I want you to be freaked out about it? No, I don't. And I'm not. I'm just saying this is something you want to be watching out for, and you want to factor it in. Yeah, if the numbers turn, the markets could turn. You could see a lot of things happening at once. So as much as, wow, it feels good, roll with market that's been winning, make sure you're also protecting yourself, because these risks, they're here, they're real, and they will be here for the foreseeable future, no matter how the Fed stuff plays out. And that's my take on it. I'd love to know what you think. Chuck at MoneyLifeShow.com. Thanks so much for the letters and the questions, everybody. Up next, it's Market Call time. We're talking stocks with Jed Ellerbrook from Argent Capital. Stick around.
Asset managers, you know how hard it is to stand out in this crowded space. VettaFi is a unique partner that can help you across the entire product lifecycle. With a best-in-class index factory and an award-winning digital marketing team, VettaFi can help you build the products of your dreams, optimize your distribution efforts, and grow your assets under management. Learn more at VettaFi.com.
Jed Ellerbrook, portfolio manager at Argent Capital Management, is here. We're talking about stocks, buying businesses, and this is the Market Call. Welcome to the Money Life Market Call, the part of the show where we talk with experienced money managers about how they do their job, what they look for that determines their buys and sells, what they see happening broadly on the market, and how they are putting it all together. Making his debut on the show today, Jed Ellerbrook, portfolio manager at Argent Capital Management. If you want to learn more about the firm, argentcapital.com is the website. And the firm itself, well, I'll let him explain how they do it, but they are investors who are looking, not so much at the momentum and the other things. They're looking at valuing the business and how they then get it from there. But again, if you want to learn more about what they do, argentcapital.com, just like it sounds. Jed Ellerbrook, welcome to Money Life.
Hey, Chuck. Thanks for having me. Great to be here.
We always start with methodology, and I probably ham-handed it a little bit there, but I know that you guys are business-centric investors, and business-centric really is not quite as easy as it's value or it's growth. So explain what it is that you do and what makes a business stand out to you to say, this is what I'm going to buy, that's what I'm not going to buy.
Yeah, great. Thanks for the question. You're right. Argent Capital isn't growth or value. We're interested in both. We love seeing both with the stocks that we own in our portfolios. We call them enduring businesses. And for us, that's three components, all of which are required for us to be interested in a stock. The first one is secular growth in the business's cash flow. So what that means is a business that's growing because of some secular or durable trend that we expect to exist for a long period of time. So an example of that is Amazon and the growth of their AWS cloud computing business. It's been growing for the 20 years it's existed. We think it'll continue to grow at a double digit and probably 20% rate over the next 5 to 10 years. That kind of durable growth profile. Second component is a management team that has a track record of allocating capital in shareholders' best interest. And that's a different thing for each business, depending on the quality of the balance sheet, depending on the cash flow of the business and the growth opportunities that a business has. In that Amazon's case, they are plowing as much capital as they can generate. All the cash flow they're generating is going into CapEx to open up new data centers, which is enabling their continued growth. And then finally, a business that has a durable competitive advantage over its peers. There's some tangible or specific reason why this business can generate a really good return on invested capital and then use that capital to reward its shareholders.
If you are agnostic to growth or value, where, if at all, does price fit in? I mean, how much does it have to be priced right if what you're saying is I want an enduring business, meaning I'm going to be a long-term investor, and today's price matters less to me than what I'm going to be getting in 5 or 10 years, if that's your average holding period?
Yeah, so we identify those top enduring businesses. That leaves us in large cap land. ABIG, by the way, is our Argent large cap ETF. That's what I manage. We use that enduring business screen to get us down to about 100 companies left. From there, we apply kind of some valuation parameters and try to identify our favorites amongst that list, both in terms of business quality and growth, but also valuation. And specifically for valuation, we look at both kind of absolute and relative valuation metrics. We're interested in where the stock trades relative to its long-term history, and also relative to the growth prospects that we see them having over the next, say, 5 years.
Given current market conditions, how much, if at all, did current events, things like tariffs, et cetera, play into any changes you made? I mean, obviously, we had to take some time to figure out how they would play out. But when you look at a business and you want something enduring, but you see a situation like tariffs, which could have an ongoing impact, does that weigh in, or is that a headline risk and it doesn't really change anything?
Maybe I can use that Amazon example once more to answer this question. The tariffs were a pretty big near-term threat to Amazon's business. A lot of the goods sold on Amazon's website are imported from China. If those products all go up in price, say 15 or 20%, that's going to cause people to do less shopping on Amazon. And that's going to specifically hurt their third-party advertising business that's attached to the retail website. Those advertising dollars are very high margin for Amazon. So the tariffs were a big threat, and Amazon stock really lagged in the first half of 2025 on those fears and that threat. We did not trim the stock. We did not sell the stock. It remains our largest position. And the reason we did so is because of that longer term view that we take. Our fund and all of our strategies have about 20% turnover per year. So our large cap strategy has 30 holdings. That means we're buying, roughly 6 new ideas per year, selling 6 of our 30 each year. That 5-year view led us to believe that, the tariffs would be bad for Amazon short term. But I think if you look out 2 or 3, 4 years, you would see Amazon's, kind of shipping and logistics scale provide them some advantages. The sheer size of their website gives them and their buyers a lot of negotiating leverage with suppliers. And so I think, the tariffs would have been bad near term, but long term, I think they would have been, immaterial net, or maybe even a slight positive, just due to those scale advantages they have and the fact that they're hoovering up so much of the online spending that we all do every day.
Let's put this down to brass tacks and move away from Amazon, because it is your biggest holding, but give us an idea of something else that works for you, something else that might be the poster child for the methodology.
Yeah, I can give you another one. TransDigm is another top 10 holding of ours. TransDigm is a company that makes its profits primarily through the sale of aftermarket parts for both commercial aircraft and also defense aircraft. That stock declined, 10 or 12% after their most recent earnings announcement. The stock was down because aftermarket revenue growth was a little bit lower than people expected, and they didn't raise their guidance. They just kept it flat. Investors were hoping for a little bit better than that. That doesn't make us less enthusiastic about the stock. When we look at the company, we're focused on those key tenets of the enduring business philosophy. So durable growth. The aftermarket is going to be a strong growing end market, I think, for years and probably decades to come. TransDigm has a really strong competitive position in that area. They're primarily selling proprietary single sourced parts. So these are little things on an aircraft that aren't super expensive in the grand scheme of things, and they occasionally break or need to be replaced or fixed as part of regulatory checks or just general wear and tear. So the cargo door handle, occasionally it snaps, have to replace it. Those are the types of things that TransDigm is supplying to airlines and aerospace suppliers. So that short-term, dip in aftermarket revenue growth, yeah, that's a negative, but no, it doesn't change our investment thesis on the company. We think that end market is going to grow long-term, and we also think that Boeing is going to start catching up on deliveries of new aircraft, and that's another end market that TransDigm supplies. And then the third piece of their customer base is the defense market. And of course, defense spending is growing very strongly. It grew double digits for TransDigm this quarter and this year, and we think it's going to grow at a pretty appealing rate for some time to come.
TransDigm Group is TDG. That's the ticker symbol there. You talked a little bit about how you are going to make roughly 5 purchases a year and 5 sells in a 30 stock or roughly 30 stock portfolio. What makes you sell, and what's something you've moved away from recently?
Generally, the thesis or the reason for sale is kind of the opposite of what we're looking for when we're buying stock. So if that 3-legged stool enduring business philosophy, if one of those tenets are broken, that would cause us to sell the stock. I can give you a recent example of that. Invisalign, Align Technology, ticker ALGN, that's a stock that we'd owned for a couple of years. I think our investment thesis was that the company is the dominant supplier, the main brand name that consumers know for clear aligner teeth straightening. I think that's a growing industry long term. I think they have a dominant competitive position. They have the only brand that people really know and can name off the top of their head. And I think that the management team and the capital allocation has been good over the long term. But what we underestimated about the company was just how sensitive that demand was to higher interest rates. High interest rates cause people to defer purchases. These are fairly high ticket. And about a third of people that use Invisalign finance that purchase. And those financing rates went up quite a bit here the last couple of years as the Fed increased its interest rates. Yeah, I think interest rates probably aren't going back to zero. So I think we overestimated consumer demand, and we're too optimistic about the company's growth rate. That kind of breaking of our investment thesis caused us to move on from the stock.
Well, now we're going to get your quick and dirty take on some stocks that my audience is particularly interested in.
Quick and dirty.
Love that game.
Yeah, we do love when we kind of gamify things and get to quick and dirty, our lightning round. Today we're doing it with Jed Ellerbrook, portfolio manager for Argent Capital Management. He is the manager of ABIG, ABIG. That's the Argent Large Cap ETF. And I will just point out, we didn't even talk about timing on that because that ETF came out, it made its inception on April the 8th. Think about what the market was doing, but that also means that basically it came out right when things bottomed. I mean, not quite at the perfect bottom, and they didn't do that intentionally. They could not have seen that coming. I'm just pointing it out that this was fortuitous timing, but the fund itself fairly new. Again, if you want to learn about the firm and the fund, argentcapital.com. Quick and dirty is our lightning round. We're going to jump straight in, and we're going to start with 2 related requests from Pat in Swansea, New Hampshire. He wants to know about MasterCard and Visa. That's MA and V.
Yeah, awesome. Chuck, I'm not that good of an investor. I wish my timing was that good. So MasterCard and Visa, 2 outstanding companies, really dominant competitive positions, the primary payment rails that consumers use for credit card and debit card payments, not just in America, but globally. People are slowly shifting their spending from, cash and checks to more digital forms of payment and cards. That's good for MasterCard and Visa. There's been a little bit of investor concern lately on these companies around all the crypto bills being passed and new services being launched by these companies. There's a fear that dollars might be replaced by Bitcoin and people might be using those crypto payment rails in place of the traditional credit debit payment methods that I described earlier. That's caused a little bit of negative thoughts to enter these stocks. Valuations have come down a little bit. They've underperformed it here a bit over the last couple of months. We are long-term owners of MasterCard and Visa, and we continue to like them. We believe that Bitcoin, the Genius bill that passed, we think those things are just as likely to be tailwinds for MasterCard and Visa long-term as they are to be headwinds. I think there will be some aspects of these new capabilities that harm MasterCard and Visa's volumes, but also some that contribute. And let me share some of the tailwinds, or one example at least. The on-ramp and off-ramp process to buying crypto and Bitcoin will often involve MasterCard and Visa. It's similar to a cross-border payment, which is a high-margin activity that MasterCard and Visa help consumers and businesses navigate. The more on-ramp and off-ramp activity there is from one currency to another or one cryptocurrency to another means more business and more profit for MasterCard and Visa. So we remain optimistic on those stocks, think they're good buys today, and are big investors in those two companies.
Would you mind stepping aside? I've got a purchase to make.
That's a buy on both MasterCard and Visa, MA and V. Our next request comes from Les in San Diego, California. He wants to know about Houlihan Lokey. The Class A trades under HLI.
Houlihan Lokey is a business not many know of, but it's a hidden gem. It's an outstanding company. They primarily do merger and acquisition advice for businesses, and they also have a restructuring practice that's a good kind of counter-cyclical buffer for that volatile, economically sensitive M&A advisory business. Both businesses are industry leading. They're gaining market share in both areas over time. Houlihan Lokey has an outstanding management team. We are coming out of a low M&A volume period here in America. And so I think that there are really good growth prospects for this company, both long-term, but also short-term kind of cyclical recovery. We've seen that stock do very well as that optimism starts to get priced into the stock, but I think that there's more room to go, and we expect U.S. and global M&A volumes to recover pretty strongly over the next couple of years. And I think that's going to fuel companies like Houlihan Lokey, but also the alternative investment management companies that are out there in the markets today. Blackstone is one of those.
When you buy here, it's going up.
And you heard that it is up already, but there's room to go on HLI, Houlihan Lokey. That's a buy. Our next two requests come from Richard in Chula Vista, California. The first, Progressive Corp, PGR.
Progressive is one of our favorite companies. This is not an economically sensitive company, kind of the opposite of Houlihan Lokey. Auto insurance is about as much of a necessity as exists. Progressive is the leading company in auto insurance. They've been gaining market share over their peers like State Farm, Geico, Liberty Mutual, Allstate, et cetera, for years and years. And that's been especially dramatic here over the last couple of years because, as we all know, the price for auto insurance has gone up a lot over the last 5 years because the cost to repair vehicles has gone up significantly. And there's so much more electronics and semiconductor content in vehicles today than there was 10 or 20 years ago. Progressive's edge over its peers lies in its pricing abilities. They have more intelligence and data about drivers than other car insurance companies, and they're better at pricing policies than anybody else, which is the single most important point of differentiation. If you price an auto insurance policy too low, you lose money. If you price it too high, you're not going to get any customers. So being just right is really important, and Progressive is better at that than everybody else.
Bye.
It's a buy on Progressive, PGR. Richard's other request is shared with Bill in New Orleans. They both wanted to know about Avantor Incorporated, AVTR.
Yeah, we're not fans of Avantor. We like that industry, bioprocessing, providing the kind of key inputs that go into drug manufacturing. I think that's a growing industry over the long term. There's a lot of drug and biopharma related R&D spending. There will be a lot of great new life-changing drugs that come to market, but Avantor's competitive position is weaker than many of their peers. And there's a lot of price competition for the services it provides to drug companies these days. A stock we like better is Danaher and also Thermo Fisher. Both those are larger, more capable, better diversified, and I think better managed businesses.
So, Avantor, AVTR.
I don't want to think about this. I'm selling.
But you can go towards Danaher, DHR, or Thermo Fisher, TMO. Our last request comes from Lance in Bethlehem, Pennsylvania. Fortinet, ticker symbol FTNT.
Yeah, we own Fortinet and ABIG. We like the company. We've owned it for a long time. We own it in some of our other strategies as well. Argent Midcap is AMID. We own it there as well. Fortinet, I think, is an outstanding business. It's managed by its founder, who's been around for decades now in the industry. And the stock just declined 20% on earnings a couple weeks ago in early August. We think this is a really good buying opportunity. The company sells cybersecurity firewalls, both virtual and physical firewalls, along with associated products. That's a growing end market. It's growing double digits per year, has been for decades, and I think will for decades to come as well. The valuation is attractive after this decline. And I think that the decline on earnings was really excessive and kind of out of line with the fundamentals, mostly due to some kind of management miscommunication on their conference call and in their preceding analyst day 6 months earlier. I think there's just some confusion about customer, buying activity. And I think as the company reports their next couple quarters and shows investors that demand does remain strong for their products, that revenue will be growing double digits as they have been in the past, I think investors will regain their comfort and confidence in the company. And one more thing we like about the company, when the stock price goes down, as it has here in the last couple weeks, the management team steps in and repurchases shares with the company's cash on their balance sheet. The company maintains no debt, so they have a lot of flexibility to do this action and buy when others are selling at attractive prices. Just in the last couple weeks, Fortinet has bought back over 2% of its shares, and we think they're going to continue to be really aggressive buying back the stock at these low levels until it goes back up, which we're confident it will.
So we finish on a high note.
Buy it outright.
That's a buy on FTNT, Fortinet. And speaking of good buys, we've come to where we have to say our goodbyes to Jed Ellerbrook. But Jed, this was great. Thanks so much for doing it with me. Let's do this again down the line.
Thanks, Chuck.
Jed Ellerbrook is portfolio manager at Argent Capital Management. He's manager of ABIG, the Argent Large Cap ETF. You can learn more about the firm and what it does at argentcapital.com. And we'll come back. We'll tell you where Jed agreed or disagreed with some recent guests, and then we'll cross the finish line. So stick with us all the way till the end. This is Money Life.
Did you know that global generalizable robotics represent a $24 trillion investment opportunity? Top robotics and AI companies are actively reshaping industries across sectors. Learn more about capturing this investment opportunity at Vetify.com.
Lots to get through, not much time to do it as we wrap up the August 28th show. Lots of crossover with Jed Ellerbrook from Argent Capital Management. Started with Amazon, his largest position. Just over a week ago, Tom Martin from Globalt Investments had it as a buy. Dryden Pence, Chief Investment Officer at Pence Wealth Management, was buying it back on July the 2nd. Then during Quick and Dirty, well, you had MasterCard and Visa both being buys. And this isn't the first time this week because Jeff Oxshore from the Oxshore Focus Fund liked both MasterCard and Visa when he was here on August the 26th. But with MasterCard, Hank Smith from Haverford Trust was buying it on July the 15th, and Greg Halter, Director of Research for Carnegie Investment Council, was buying it back on March the 27th. On Visa, David Miller, Catalyst Funds, was buying it on August the 1st. John Smucker from Marietta Investment Partners had it as a bit of a qualified buy back in mid-April. Progressive, a buy today, also a buy with Jeff Oxshore. But remember, Jed was saying we're not value and we're not growth. Jeff Oxshore, definitely value. That's distinctly there. He was buying Progressive back earlier this week. Mike Bailey from FBB Capital Partners had Progressive as his poster child in April. Greg Halter from Carnegie was also buying it. Then you got to DHR. Danaher was an alternative to Avantor. On Danaher, Brian Lee from Blue Zone Wealth Advisor was buying it in the middle of April. Mike Bailey was buying that one too. And Fortinet was a buy today. We had Kirk McDonald, one of the other portfolio managers, on from Argent Capital back at the beginning of April. He was buying it then, which is not necessarily a surprise, but good to see the consistency at the very least. Tomorrow, Jay Hatfield from Infrastructure Capital Advisors, Kim Flynn from XA Investments, and more. Be here. Meanwhile, if you're looking for something to celebrate, today is National Thoughtful Day, otherwise known as Thoughtful Thursday.
I don't think he's ever had an original thought.
Well, not when it comes to holidays, that's for sure. It's National Power Rangers Day. It's Race Your Mouse Around the Icons Day. It's National Bow Tie Day. It's Rainbow Bridge Remembrance Day. Always a good time to remember your past loved dogs, etc. For me, that's Frio, of course, and Fripp and the cats, Gracie and Minnie and others. Yeah, they're always good memories there. And then on the food front, National Cherry Turnover Day. I can go for that. And it's actually National Red Wine Day and International Cabernet Sauvignon Day.
Alcohol is my way of life, and I aim to keep it.
My guests today were Todd Rosenbluth, the head of research at Vetify, Vetify.com. Jeff Clark, head of defined contribution research at Vanguard, Vanguard.com, with a direct link to How America Saves in our show notes. And Jed Ellerbrook from Argent Capital, ArgentCapital.com. Thanks to them. Thanks to Rob Floyd, my producer. Thanks to Maho, my dog. But mostly, thanks to you for being here, because you make this special and worthwhile for me each and every day. The Money Life quote of the day comes from Nick Majuli. Didn't say it on the show, but he's been here, who said, if you're behind on your retirement savings, don't just save more, exercise more. Improving your health will allow you to work longer, save for longer, and have fewer medical expenses in old age. It's a far better solution than saving more through catch-up contributions. Yeah, we talk all the time about money, but health equals wealth. So take advantage of that, and remember while you're doing it that until we do this again the next time, the best thing you could do for your money is not worry too much about it. Have a great day, everybody. Stay safe and calm. We'll see you here on Money Life again tomorrow.
The people who appear on Money Life are here for your and their own entertainment. Don't take advice from us or any other podcast without doing more research and/or consulting your financial advisor. We believe our guests provide reliable information, but we can't and don't guarantee the accuracy or completeness of their statements. Opinions expressed on Money Life are those of the host and guests only and reflect their personal thinking. They're not representative policy or strategy of any employers or sponsors. This show is produced by Money Life Radio, which retains all rights to the content. If you want to use any part of this show for your own purposes, be they good or evil, you must get our written permission first. And remember, with great financial information comes great responsibility. Please act responsibly.
I thought we'd never get that mess straightened out.